Lynette has often talked about an overnight financial reset. Why are assets such as checking and savings accounts devalued, but not outstanding debt? We'll start there. There's more question at the end.
Okay. So it's not that the outstanding debt is not also currency devalued. It's just that at that juncture, the interest rates are so high that you can never get out of that debt. That debt just doesn't go away. And your other assets like your checking and savings account do not carry the same label of interest on those. So it's a lot more obvious. And the goal is to have you in debt permanently anyway, because then you're a debt slave and you have to do what they want.
Well, yeah, you definitely have to keep working, keep in the system, keep playing the game, right?
Right, but you're never going to ever get out of debt when it's a variable rate. Now, the fixed rate debt, yeah, because then as soon as that overnight revaluation happens and you see gold go up, that's when you grab enough of it. What might take you 100 ounces now might take you a quarter of an ounce then, right? It depends, because I don't know what that reset number is going to be, but you grab that and you pay off that fixed rate debt. The biggest problem on debt is the variable rate debt. That's where you're really in danger. And we're kind of seeing something like that play out right now in Great Britain with the homes, with the mortgages, because they do a lot of variable rate debt. So they're on the mortgages. So they're only fixed for a very short period of time. And now, as those mortgages are resetting into a higher rate environment, it's kind of shocking for most people.
Yeah, I bet, because that's a significant increase in the monthly payment.
Oh, yeah. I mean, the interest is, 3 times or more what it was when they took out the loans to begin with? That's going to make a huge difference.
Yeah, for sure. Okay, so the second part of that question is, are retirement accounts such as an IRA or 401k also subject to the same devaluation?
Yes, and in fact, it's a double whammy. And if you look at what's happening in the markets right now as far as that double whammy, we have the markets. I know that there were, hopes of a Fed pivot so that the last couple days the markets have gone up. But that's why they went up, in the hopes of a Fed pivot so that they stop raising interest rates. But when you're looking at your retirement account, such as an IRA or 401k, number one, you're subject to market turmoil as well as that overnight devaluation. So it really is a double whammy. And it's a double whammy right now with the markets going down and the high inflation. That overnight revaluation is just, it's the difference between, if I went into your house every night for 30 years and I took one button, right? You'd lose a lot of buttons after 30 years, but you probably wouldn't notice it as I'm doing it right along. However, if I walk into your house tonight and take out 95% of every button in your house, tomorrow morning you're going to notice it. And so that's the difference between inflation at 2% and inflation at 10, 40, 50, 1,000, whatever that hyperinflationary number is. And that's the way we have to look at it. Either way, I'm going to end up with a lot of your buttons.
I like the analogy, but the good thing for me is I have a wheelbarrow full of buttons, so it'll take a long time.
Well, I have a wheelbarrow full of gold and silver. So even on those, even for my retirement, I don't have a formal IRA or 401k anymore. And I used to have a SEP IRA. But I don't have that anymore. Do I still have a retirement plan? You betcha I do. Does it matter to me what's happening with the markets right now? Not at all, because not one penny is in those markets, not one penny. If you like this clip and you want to watch the full video, just click right here. And to subscribe, click right here.